The Defiance Nasdaq 100 Income Targeted ETF, QQQT, is it time to buy it or time to sell in retirement accounts? We're going to break that down today. Hey everyone, welcome back to the channel. I'm Doug, the Retirement Guy, with all your monthly ETFs. And this one actually has come from a few of our YouTube viewers. When we did our NASDAQ 100 best of, they kept asking, hey, what about this fund? What about that fund? Why didn't it make the cut? Well, this one came back to it, and QQQT was the first one that came across. And we wanted to break this one down and show you the, I'll call it under the hood performance of QQQT. And does this make sense for a retirement account? Before we dive into this, I got to do a shout out to all of our 13,000 plus subscribers. Welcome back and thank you for supporting the channel. And also our Patreon supporters. You guys keep this channel afloat. You keep this thing rolling. If you're not part of the Patreon group, don't be afraid. Go in the description. There'll be a button right there you can click. You can sign up for free. I'm not one of these guys that charges for everything. You can get into it for free. And if you can help support the channel, we appreciate it. And there's plenty of different ways to do that. Let's get into today's video about QQQT. Is it time to buy or sell? Well, right off the bat, I do this. Past performances does not guarantee future results. The information provided in this video is for educational and informational purposes only. If you are looking to do financial advice, always contact a financial advisor. As I am not a financial advisor, I am just someone who has been heavily into all of the retirements and working with the money. So the Defiance NASDAQ 100 Income Targeted ETF, QQQT, as I said, this comes from the Defiance family of ETFs. Now, this fund is a large cap equity fund, and the fund actively managed, and it seeks to generate an income of 20%. Now, this is why everyone is always excited about this fund, is because they're targeting. And I want to make sure you understand targeting. Targeting is like an estimate. It's what we're shooting for. We're not guaranteeing it. What we're doing is we're shooting for a 20% annual income. And they do this by selling daily index call spreads on the NASDAQ 100. Now, don't go crazy. This is not about being paid daily. This is where they're selling those index calls and they're readjusting every single day. What's the market doing today? If it's up, if it's down, setting our targets where we want to be. So they're targeted 20%. They're paying out monthly. Their assets right now, and we'll break this down even farther, but about $40 million. These guys came out in 6/24 of 2024. Okay, so basically June of 2024. So we're now darn close to 2 years old. So when we take a look at over the past 12 months, how has this fund done? Well, this is where we're going to break underneath the hood a little bit more. Assets, like I said, $40 million on their assets. Now, the expense ratio, 1.20%. Now, I know a lot of people focus on those expense ratios. All the numbers I give you have this already built into it. But 1.20% is going to be called high, but you have to remember this thing's dealing with a daily basis, and most people are going to pay a financial advisor, anywhere between 0.75% to 1% to manage their money. And you have active managers here doing a similar thing at 1.20%. 2.28 million shares outstanding. It's collected $3.65 in distributions for a yield total of 20%. So it hit their target this past year. Like I said, it was monthly. Now the price of this thing, you can see it as the 52-week low at $15.24, a weekly high of $19.19. This thing, as the time of doing the video, was coming in between $18 and $18.28. So we're bouncing really still on the high side, which a lot of the funds currently are on that high side. But this is a fairly lower price ETF to get into at only, like I said, about an $18 to $19 price point. Now we take a look over the past 12 months. They've had a 10.64% growth and a 20% yield. which gives us a total return about calculating out to about 36%. We look at the chart and we primarily see that the thing had its drop off here in April, primarily because of the Iranian war and everything that went on with that. But since then, everything has developed right back out of it. So it's saying that it's not a fund issue, it's a global policy issue. And it's already said, hey, we know the direction we're heading now, and let's make it happen and where we're sitting. So fairly, on one hand, you draw a line across those. You'll say you're smooth right in that 18, I'd say between that 17 and 19 area. You're pretty standard rolling right through that section. So over the past 12 months was actually a very good performance across the board. Now, remember, past performance does not guarantee future results. They're still targeting 20%, not guaranteed. They're trying to get some growth, not guaranteed. So let's see how they've done. So we take a look at the year to date for 2026. The fund is still bouncing in those ranges that I told you before, and you can see before the war we were down about 15 and a half. Okay. Once we got into the war organizing moving forward, we moved back up to the $18.23 point. We're sitting at about 4.6% growth over the first, where are we at now? Almost 5 months. Okay. Our targeting yield, 8.3%. It's still on target to hit that 20%. So our total return of 11.83% so far is giving us a very solid numbers year to date along the board. Do we expect to see the targeted? The way it's looking, yes. Do we expect to still see some growth? The potential there is yes, but we can't guarantee that. We take a look at the holdings. Now, this is the one thing that you always look at. You're really getting into the nuts and bolts of the funds and looking at the holdings. And this fund works off of QQQ. Okay, this is Invesco QQQ, which is the Nasdaq 100. They're basically all into that fund. So this is a true index trading fund. And what their goal is to try to create income versus growth. But you can see where they do develop growth across the board. When we look at the distributions, now we take a look at this one. We give you the current year to date. It's averaging about 29 cents per share per month. Okay. I look at the charts, and what I try to see from this stuff is I want to call straight lines. I love to see flat out lines, and that means you can almost count on it in a retirement fund. You can just count on so much money each and every month coming to your account, almost like clockwork, and not worrying about it. When we see the drop off, it is May of 25. It climbed right back up all the way until we started again. As the price slowly dropped off, dividends dropped off, and then when it spikes back up. So when I always say this, you take a look at 29 cents as your average. When you're looking at getting 32, 33 cents per share for about 2, 3, 4 months in a row, those what I call are either A, bonuses, or B, those are what you use as your cushion. So when things drop down to the 25% that we saw in April, that you're using those funds to help work accordingly. Now, taxes. How are taxes used? Where should I put this? Should this be in my brokerage account? Should it be an IRA account? Should it be in a Roth fund? Where do I put this? Well, here's the other bonus of this thing. And this is how they handle their taxes. They are actually using the tax treatment options of that Section 1256. So if you're not familiar with 1256, what they do is a 60-40 rule. Since the options are based on a broad-based index as the Nasdaq 100, they qualify for the Section 1256 contracts, which under the IRS rules, 60% of your distributions are going to be taxed at the lower long-term capital gain rate. So that means that rate is 0, 15, and 20% across the board. Now, 40% of your tax are going to be in the short-term capital gains, regardless of how long the fund has held the position. So those are going to be taxed at I call it the more efficient tax way, and taxed at ordinary income. So 60% of your dividends are going to be long term, 40% going to be short term. Now, historically, this is another big thing. Historically, the estimates of the Section 19 notifications that QQQT has historically shown that anywhere from 85% to 100% of the monthly distributions may be estimated to be ROC. Now, what is ROC, you ask? Return of capital. Now, this is a unique way. And I'll tell you, once you start really studying this and understanding this, you'll be like, wow, this is interesting. And how they do this. ROC is a tax deferred system. Okay. ROC distributions are not taxed in the same year that they're received. Instead, they reduce your cost basis. So I'm going to give you a very quick example. And I actually have a video out there of ROC explaining it a lot more detail. So you can search in the history, or I believe I have a link in the bottom. But you can do a look for the ROC of this one. And what it does, if you have a fund that you buy and you pay $100 for it, and you collect $10 in distributions, and those distributions are classified 100% ROC, return of capital. What they do is they take your cost basis and say you have bought it for 100, it's now $90. Didn't change anything. It didn't change the value, didn't change it. All it says is your cost went from 100 down to 90. So that means you got your money back. Your fund's still worth the dollar that originally was. So what it is you don't pay your taxes. You don't pay capital gains taxes until you sell the fund, what, 2, 3, 4, 5, or never. So it really defers your taxes along the point of it. You can see why you can hear the excitement in my voice is that not only are you taking and using the 1256 selections at 60/40, you're also using a lot of ROC. So they've really handled taxes the right way, or the most efficient way for you. That you're either going to have, but again, 60% of your fund is set up for the long-term taxes, and then 85 to 100% of your thing is going to be set up for as a ROC. So realistically, that 15% falls into 60%, and you're really paying not a lot in taxes across the board. A lot of cases, you're probably paying zero until you sell the fund. So let's take a look at year to date, the total return, as we talked about. 11.83% so far for year to date, and 36% over 1 year. So across the board, both funds doing very, very well, or year to date and doing very well. When we look at the year to date, why I look at this one so much is I want to see what brackets it's bouncing through. You can see we've had a good run lately, and that's increasing our percentages extremely high, which means that's primarily coming from a lot of growth across the board. But when we take a look at the fund, we've been dialing into right at that 20% mark, which is what the targeting is for the income. How well has it done? So it hasn't had a great growth pattern over the first 2 years until we got into the end of this year, but been holding fairly strong. When we look at the year to date, we were actually bouncing between the 0% to that negative 8%. Now we look at that, that's a lot of geopolitical side of it. Okay, that's a lot of the world saying, are we going into war? Or are we not going into war? Are we going to have oil? Or are we not going to have oil? What is the game that's being played? Once they said, look, we're moving in this direction, we're doing this, you see it rocketing, getting back to where it's called normal settings, to where we've seen it over the past year. This is why I always say, again, total, past performance does not guarantee future results. But when you look at charts and you study charts like I do, you see these things saying, where are we going at? Are we have a select natural run? And we work accordingly. So is this good for retirement? Well, if we go back to the original question, should we buy, should we sell in a retirement account? Well, here's my thing. First off, classification. If you follow what I do, you will see I have a 3-bucket system. 1 is foundation, 1 is for growth, and 1 is for income. This fund here, would be in my classification of income because it's designed for income. It's not designed for growth. It's designed originally for income because of that 20% targeted income category. So it's really designed to get that. The growth is a bonus. So you could put this in the growth section, but realistically it's built for income, and that's why I put it in the income side of it. Growth is what I call my bonus side of it. As it grows, great, things are looking good, but I want that 20% yield. When I look at the total return numbers so far, 11.83% for year to date, 36% over the past 12 months, it shows me that the fund is actually doing what they're asking it to do, and that is to create that 20% yield and then to try to get some growth out of the package. So overall, is this a good fund to have in a retirement fund? I put it to both sides. I would keep it 100% is a buy if you don't have it and you want to mark it into uh, adding more to a Nasdaq index side of it and playing that game that we see is doing very well. I'm saying yes, this is a good buy to have in a retirement package. If you currently own it, I would not sell it. I'd continue let it ride to generate that income. So far in the first 2 years, it looks like things have done well with hitting their targets. And the way NASDAQ's looking, probably another chance to get their third year into it. So let me know your thoughts of what do you think? I believe I'm on this. It's only my opinion. Remember, I'm not a financial guy. I always tell you to talk to financial people if you really need the true answers. But I like to see what other people think. Do you think QQQT is a strong piece for a retirement account? Do you personally own it? Leave a comment below. I'd love to hear what you have to say.
Thank you for watching.